Hello, and welcome to Credit Compass, your guide to navigating European credit markets. Happy St. Patrick's Day to my Irish listeners and colleagues. Over the weekend, I watched the exciting conclusion of the Six Nations in Wales. It was an exciting finish, if not the right results across the board, at least for me anyway. There is no Canada in there. And the next day, I felt the full impact of rising petrol prices while filling up, including the familiar 20p motorway premium. Oil prices remain elevated, and limited support for the Strait of Hormuz escorts is likely to keep them that way in the near term. This week, we'll look at the direction of European capital markets policy. We'll also unpack a busy slate of central bank meetings as market pricing begins to reflect a potential turn towards higher rates. Finally, we'll review recent UK data, which suggests the year has started on a weaker footing than expected. All right, let's dig in. Let's start with Europe. This week brings European Commission committee meetings. Initially, the focus was expected to be on competitiveness and deeper market integration within the Union. However, developments in the Middle East have likely shifted priorities, at least at the margin. That said, there has been tangible progress in the Savings and Investment Union. According to a Reuters report last week, Germany, France, Italy, Spain, Poland, and the Netherlands are all backing centralized supervision of capital markets. This is a meaningful step towards a more unified pan-European capital market, especially given the scale of these economies and their respective capital markets themselves. This report follows the ECOFIN meeting on the 10th of March, and while details remain limited, ministers are reportedly targeting a joint position by mid-year. Beyond supervision, the Commission's December package included proposals to introduce a pan-European market operator status, allowing firms to operate across multiple EU venues without requiring additional local licenses. It also aims to harmonize financial services rules and amend frameworks such as the Central Securities Depository Regulation and the European Market Infrastructure Regulation as well, with the goal of reducing fragmentation and duplicative processes. So, what does fragmentation actually mean in practice? Well, today, a mid-sized issuer raising capital across multiple EU jurisdictions can face duplicated listing requirements, settlement frictions, and higher legal and compliance costs. In effect, the cost of capital in Europe remains structurally higher than in the US, not necessarily because of risk, but because of market infrastructure. A more integrated market, if executed properly, could deepen liquidity, compress spreads, and broaden the investor base, particularly for high-yield and mid-market issuers. But can all of this translate into something actionable in the near term? Well, progress is possible, but timelines remain uncertain. If member states can align on a common position, which this suggests is possible, we could see movement at the June Commission meeting, with implementation potentially within a year. That said, this assumes relatively smooth negotiations, something EU policymaking doesn't always guarantee. However, the backing of these nations, particularly Germany, suggests positive momentum. Now, turning to the central banks. This week brings a notable convergence of policy meetings. The ECB, Bank of England, Sveriges Riksbank, and Swiss National Bank are all set to announce decisions on Thursday, just after the Fed and the Bank of Japan have made their decisions. No major policy changes are expected, with consensus pointing to rates remaining on hold. However, the focus will be on forward guidance, particularly whether policymakers signal tolerance for higher inflation driven by energy costs, or hint at renewed tightening, or potentially policy actions to support the rising energy costs. Market expectations have shifted meaningfully. In Europe, there is now growing anticipation of potential rate increases, while earlier expectations for multiple UK rate cuts have largely faded, with only one now expected. The key uncertainty remains the duration and impact of the Iran-related conflict. The question is whether this represents a temporary inflation shock or the beginning of a more sustained cost pressure cycle. There are reasons to believe the impact may be less persistent than previous shocks. Since the Russia-related disruptions, many firms have diversified energy and input supply chains. However, companies have also become more proactive in passing through costs, which could accelerate near-term inflation dynamics. Much will depend on how long disruption in the Strait of Hormuz persists. If energy-driven inflation proves temporary, central banks can look through it, focusing instead on core inflation and wage dynamics. However, if higher energy costs begin feeding into wages and broader pricing behavior, that's when policy becomes more restrictive. In other words, the distinction between a relative price shock and a generalized inflation process becomes critical. Markets at the moment appear to be pricing something in between, which leaves room for volatility as the data evolves. So, we will have to wait and see what gets said by the central banks and whether or not they are treating this as temporary or not. Now, let's turn to the UK. Recent data suggests a softer start to the year. GDP growth for January came in flat, below expectations. Industrial production and manufacturing also disappointed, reinforcing a weaker near-term outlook. As a result, economists have revised down their growth expectations. For a government that entered with a strong pro-growth agenda or plan, the data so far is providing limited support. Recent results from Travis Perkins this week highlighted subdued construction activity both last year and into early 2026, underscoring broader weakness in domestic demand. This raises the risk of a stagflationary environment where growth remains weak while inflation pressures persist, alongside a potentially deteriorating labor market. There are, however, some tentative positives. The pace of employment declines appears to be stabilizing, and wage and inflation dynamics had been improving prior to the recent energy shock. Government support measures on energy costs may provide some cushion, but as elsewhere, the duration of elevated energy prices will be the key determinant of outcomes. From a credit perspective, this environment tends to pressure cyclical sectors first: construction, consumer discretionary, and parts of industrials. For lenders, the key question is whether weaker growth translates into margin compression and rising refinancing risk, particularly for smaller or more leveraged issuers. So far, we're not seeing broad stress, but dispersion is increasing. So, where does all that leave us this week? Energy prices remain elevated and, despite recent volatility, are beginning to look more structurally embedded as long as the Strait of Hormuz remains constrained. Central banks are likely to look through this initial price shock for now, but markets will scrutinize their language closely for any shift in reaction functions. Our view is that Europe's trajectory has been delayed rather than fundamentally altered, at least at this stage. Credit spreads have widened on macro uncertainty, though they remain within historical ranges, still below the wides seen last April, and broadly in line or even still inside five-year averages. Meanwhile, structural themes continue to evolve. Private credit remains in focus within the press, but recent commentary from BNP Paribas, SocGen, and Deutsche Bank suggests confidence in the asset class with no indication of systemic concern, particularly within Europe. On the technology side, NVIDIA's recent results reinforce that AI-driven investment remains robust, continuing to support broader credit demand. Importantly, issuance remains strong. European markets have seen over $90 billion of issuance in the month to date, even amid rising borrowing costs and geopolitical uncertainty. Against this backdrop, fixed income continues to present a compelling alternative to equities, particularly given current spread levels and income potential. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. And for deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macro credit. Till next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.